with all of the talk about Alan Greenspan, former head of the Federal Reserve, and with so many newspaper columnists and bloggers trying to associate his management of the Fed and the money supply with Ayn Rand's philosophy, the time has come to discuss Ayn Rand's view, or views, on the morality of money and of inflation. And before we get to that ethical question, it's important that we look at the historical context, because keep in mind, Rand was writing Atlas Shrugged and the Money Speech, for example, by Francisco, in and prior to 1957. So a lot has changed in the management of the money supply since then. Monetarism, for example, has replaced Keynesianism. But let's start back hundreds of years earlier with the question of where did this banking system come from? What is inflation as Ayn Rand meant it, as Ayn Rand criticized it, etc. Now, hundreds of years ago, there were, of course, goldsmiths, people who used gold and made jewelry and perhaps crowns and whatnot for various people, and they held gold in safes to keep it safe, big, safe boxes. And people used gold as money. We're talking about, a relatively vibrant economy in Europe. We're not talking about the frontiers of North America at this time. So people were using gold as money. Now, why did gold constitute money? Well, it's not because somebody pressed it into the form of a coin and said, that's money. It was money because money is any property that can be exchanged reliably for other property or for services. And ownership of gold, that ownership is property, and that ownership can be exchanged for other property, such as ownership of a shovel or an estate in land, etc. There were other things that at different times and in different places functioned as money. For example, in North America, tobacco at one time functioned as money. There wasn't a lot of gold floating around. There weren't a lot of gold coins floating around amongst the traders at times, or amongst the soldiers in Quebec City at other times. And so when you were trading, it turned out that a lot of people wanted tobacco. Tobacco was widely in demand, and so tobacco could be exchanged reliably for other property. So in other words, ownership of tobacco could be exchanged reliably for other property or for services. And so, by definition, it was money. Other things functioned as money at different times in different places, including bones and whatnot. But the point of the matter here is that the definition of money is not gold, or that which is pressed into a coin, or that which the government says is money. Money is that which can reliably be exchanged for property or services. And it's always a form of property. Services are not money. So, as I say, at one point gold was money, but gold is heavy. And if you traded a lot of, corn and beets or whatever for a lot of gold coin, and you wanted to store that gold coin because you didn't need to spend it all right now, you might not want to carry it around or store it at your farm. You might want to put it somewhere safer. And you might go to a goldsmith who has this big gold vault and ask the goldsmith to please, would he store your gold in his vault for safekeeping? And the goldsmith, as it turns out, used to agree to do so and would issue a claim check, an IOU, also known as credit. And I'll tell you why it was credit in a second. But they'd issue an IOU to the person who dropped off the gold, and the goldsmith would effectively be a bailee of the gold, a person with whom possession of the gold had been left. Not ownership of the gold, just possession of the gold. Ownership of the gold remained with the person who deposited the gold. And that owner had a slip from the goldsmith that said, I owe you, and then whatever amount of gold it was that the person had in the vault. Now, over time, it became the practice that rather than going and claiming your gold from the goldsmith whenever you needed it, people said, well, look, I know that goldsmith has the gold that he issues IOUs for. So if you sign over the IOU to me, then I can go get the gold, and that'll be the same as paying me in gold. And that practice got wider and wider accepted, such that those IOUs issued by the goldsmith became reliably exchangeable for other property or for services. In other words, those IOUs became money. They were money because the person who had issued the IOUs was credit worthy. They were credible. They could be trusted to honor the IOU. That's what made them credible, and that's what made those IOUs credit. Now, the credit then was money. Just as though the gold had been traded, the IOUs, or the credit, could be traded from hand to hand in exchange for property and services. All right. Well, it turned out that goldsmiths eventually discovered that people were handing their notes from hand to hand in exchange for goods and services, and not usually coming to claim the gold that the IOUs formed a claim on. So they learned that they could actually issue these receipts, these IOUs, these bits of credit, for gold that they actually didn't even have in their vault. So imagine that, okay, every day someone's going to come and claim 1/10 of the gold. And over the course of 10 days, 100% of the gold will have been claimed collectively, but at any given time, at least 1/10 of it remains in the vault, so that there's enough to honor the rare demands that are made, the rare demands for the goldsmith to honor his IOU. In other words, there was some ratio, depending on the community, depending on the circumstances, some ratio of IOUs to gold that could be maintained such that a person who came in to say, I have a claim and it's worth 1/10 of the gold that's in your vault, could come in and actually get that gold. And so nobody worried too much because the gold was always there when they came to claim for it. In other words, people came to regard the goldsmith as worthy of the good faith they had given him, and they continued to regard his IOUs as credit and as, therefore, money. So money at that time could be gold or credit issued by the goldsmith. Both were money. Now, of course, there were times at which these goldsmiths would not have enough gold to honor the simultaneous demands of the various people who came in with the IOUs, because, of course, the goldsmith had issued IOUs, more IOUs than he could honor simultaneously. And when that happened, he was exposed as someone who had not the gold to back up his IOUs, and he lost his credit worthiness, and people no longer accepted his IOUs, and his IOUs were no different than anybody else's. They were not money. They were not reliably exchangeable for goods and services because people knew that he was playing a game, that he didn't have the gold to back up all of his IOUs. Now, we have in that scenario the essence of fractional reserve banking. Banks would take in, these were the early banks, they would take in gold, they would issue receipts. Now, many people will defend this process on the basis that, well, everyone knew that they were issuing more receipts than they had gold for, so it wasn't fraud. And that's fair enough to the extent that everyone knew, or that it was widely known, that these goldsmiths were issuing IOUs for more gold than they actually had in their vaults. The fraud argument doesn't fly with me too well. It's not a very strong criticism of fractional reserve banking, or goldsmithing, if you like. That's not the critical problem. The critical problem was, in all of this, that when the goldsmith issued IOUs, because of the quantity theory of money, and I've talked about this in an earlier video on understanding money and banking, there was more gold out there notionally in the form of paper than actually that existed. Alright, so they could actually have a situation where collectively all the goldsmiths held, let's say, a pound of gold, but that there were IOUs floating around out there for 10 pounds of gold. Economically, this had the effect equal to there actually being 10 pounds of gold floating around. So gold was worth 1/10 of what it otherwise would be worth had only 1 pound of gold been out there. If there were only 1 pound of gold out there, then of course gold would be worth 10 times as much as had there been 10 pounds of gold out there. This, of course, is what makes gold a good candidate to be money. It doesn't grow on trees. It's not easily obtained. You have to locate the gold. You have to mine the gold at great expense and effort. Therefore, there's a economic brake on how quickly you can expand the supply of gold. And therefore, there's a brake on how quickly gold is devalued. That's why gold was a good candidate. Had apples been money, well then of course someone would just plant a bunch more trees and wouldn't be too hard to make valuables, make those apples less valuable very quickly in a season or two. Now, that expansion of the supply of money, whether it's pieces of paper called IOUs that are claims on gold, or whether it's apples, or whether it's literally just expanding the supply of gold by, finding a whole bunch of it and mining it, that is an inflation of the money supply. Inflation originally meant not an increase in the prices of goods and services, but an increase in the amount of money that is available to purchase goods and services with. And I'll get into why that definition was changed later on, but that is the definition of inflation that existed, say, in the 30s. It was not a definition of inflation that existed only, say, in the 1700s. We're talking in the 20th century. That was the definition of inflation, an expansion of the supply of money. Let's go back to the history a bit, though. So we've got now what are banks, formerly goldsmiths, issuing more credit than they have actual gold for, sometimes getting caught with their pants down. And the bankers decide, it would be really good if we had a central bank that we could put all our gold in, and then, if one of us, not all of it, but have a reserve of gold there, and then if one of us gets caught a little short, well, we can go to the central bank and borrow gold from one of the other banks, so that the person who comes to ask for his IOU to be honored at our bank won't be finding that his IOU is dishonored. He will get the gold he came for. Now, of course, that local bank will owe the central bank some gold, but that's okay. It will keep things going. It provides a buffer, a bit of an insurance policy. So these individual banks wanted a central bank because it allowed them to have an insurance policy of a sort against runs on the bank. A run on the bank is where all of a sudden everyone panics and says, wait a minute, he's not got enough gold to honor all of his IOUs simultaneously, so I'm going to run down to the bank and get my gold before everyone else does, because somebody's going to end up with the short end of the stick here with an IOU that can't be honored because the gold's already gone from the vault. That's a run on the bank. Too many people coming simultaneously to claim their IOUs, to claim their gold, when the banker who issued those IOUs, those bits of credit, didn't really have the gold to simultaneously honor all of them. And so that's why these bankers got together and said, let's have a central bank so that if too many people come in simultaneously, we can use the reserves sitting at the central bank to honor our own IOUs. And hopefully, not everyone will come to all individual member banks simultaneously, because then the central bank wouldn't help us at all. And that's exactly what started to happen, of course. So banks, those central banks, over time became nationalized. Why? Well, because that's the trend of things, isn't it? Collectivism is such that governments saw central banks as a way to fund their operations. Well, why did they see them as a way to fund their operations? Well, they said, look, instead of every bank issuing their own IOUs, and literally that's what happened. For example, in the 1920s, you could go around in Canada and you could find Bank of Montreal dollars. They literally said, Bank of Montreal, this dollar is a claim on so much gold. Same thing for Bank of Commerce, for Royal Bank. They all had their own money. They were competing currencies, if you will. We didn't have one Canadian dollar supply. They had different banks all issuing their own money. But a central bank was formed. That was not done against the will of banks. That was done for the banks. And sometimes it happened that these banks had organized themselves a central bank, and other times it happened that they hadn't yet done so, but the government formed one. But it happened all over the world. And historically, the case has been that governments would issue notes from the central bank, so Bank of England notes, for example, and a note would initially say, let's just pick a number, this note can be redeemed for 1 ounce of gold or for 1 gold coin. And so people would take these notes. They were lighter, they were convenient, they knew that the government was good for it, they wouldn't lie, so they would exchange these notes, and they could reliably be exchanged for other property or for services. Now over time though, the government said, wouldn't it be nice for us to give ourselves some money so we can build bridges and pay for the army and everything else without having to collect taxes from anybody? So what they did is they said, well, instead of saying that each of these notes is redeemable for 1 gold coin, let's say that each of these £1 notes, let's say, are redeemable only for a half a gold coin. Now it wouldn't have been that dramatic a shift, it would have been more gradual, but I'm just trying to give you an easy example. So they reduced how much gold could be obtained for the same amount of note. So if £1 used to get you 1 gold coin, now it could get you only a half gold coin. It would take you £2 to get the same amount of gold. And how would those initial pounds, those notes, be introduced into the money supply? Well, the government would give those notes, print those notes up, and spend them into the economy. So if, for example, they had doubled the supply of notes, and let's say that there were a total of 10 coins, and that there were a total of 10 £1 notes, and each £1 note originally could be a claim on 1 gold coin, then if the government suddenly doubled the number of pounds to 20, then, and such that each £1 note could be a claim on only 1/2 of a coin, then effectively what had been done is that the money supply had been doubled because the gold was sitting in the vault. The money that was being transferred from hand to hand was actually the notes. They had doubled the number of notes, doubled the number of pounds, and thereby decreased the value of each pound by 50%. Because now each pound could buy only, or be redeemed for only 1/2 of the gold that it used to be redeemable for. Now imagine that you've got in a sock in your drawer, £5 that were issued or earned by you, sweat of your brow, or wise investing, earned by you when there were only £10. At that point, you had 50% of the money supply. And each of those 5 £1 notes were exchangeable for 1 gold coin. So you had half the gold supply, you had ownership, really, of half the gold supply. Well, when the government went and doubled the supply of pounds, they didn't give you an extra £5. No. They issued themselves the 10 extra pounds, and they spent them into the economy. And the value of your £5 sitting in your sock or in your drawer suddenly went to half of what it was prior to the government doubling the supply of pounds. So now, in your sock, there's enough notes, in other words, there's 5 £1 notes, to collect, to redeem for, in the form of 2.5 coins of gold. So the money in your sock has been decreased by 50%. The value of it, the buying power of it, has been decreased by 50% simply because the central bank has decided to double the supply of notes that represents the same number of gold coins. In short, the central bank has inflated the money supply. And that's no different in principle than when the individual bank, before there was a central bank, issued more IOUs than they had gold in the vaults for. And in fact, this is what happened historically. In the United States, for example, possession of gold was made illegal by Roosevelt, Franklin Delano Roosevelt. And the gold was held in the Federal Reserve. American Federal Reserve notes issued by the central bank could be redeemed for gold, but only by other countries under what was called the Bretton Woods Agreement. So if they were a country that was a signatory to the Bretton Woods Agreement, or participant in the Bretton Woods system, then they could take their Canadian dollars, or their francs, or their marks, or their pounds, and they could exchange them for a certain number of American dollars, which in turn could be then exchanged for a certain quantity of gold. But Americans themselves, if they thought that they could go down to the central bank and say, hey, I don't want this Federal Reserve note anymore, I want to redeem it for gold, they were SOL, as it were. They were out of luck. It was illegal to possess gold. In fact, the gold was seized from Americans. In what was supposed to be the freest country of the world, possession of gold, that thing which had functioned as money, that thing which it's difficult to expand the supply of, that thing which it's difficult to inflate the supply of, and therefore difficult to inflate the money supply and rip people off, had been made illegal. Possession of that had been made illegal, and the Federal Reserve was now issuing notes that had to be used by the American people, and which could only be redeemed for gold by other countries. Now, that system continued, but you'll recall that there was a little war over in Vietnam, and during that Vietnam War, the Federal Reserve pumped tons of cash into existence, currency, Federal Reserve notes. And, there were claims on the gold, and there were eventually concerns around the world by these people who were, these countries that were signatories to the Bretton Woods system, that, wait a minute, I don't think there's enough gold there to honor all the demands that are going to be made by various countries simultaneously, or, within a given time period. I don't think the Americans are holding up an honorable system here. And so, that was true. They had inflated the supply of Federal Reserve notes to finance a war, and as a result, lost the confidence of the members of the Bretton Woods system. So what did the United States do? Well, President Nixon said, I'm closing the gold window. In other words, no longer can these countries redeem American notes, American Federal Reserve notes, for gold. There is no connection anymore between Federal Reserve notes and gold. They're not redeemable for gold anymore. That was in the 70s. The 1970s. And shortly after that, possession of gold was again permissible, but of course by then nobody was able to reliably exchange gold coins for most property and services. I mean, try and buy a house with a bag of coins. It doesn't work that way. Not reliably, anyway. And so gold is not anymore money. It doesn't function as money anymore. It's valuable. A lot of people will buy it. You can even mint it into the form of coins, and people will buy the coins. But it's not money, because it will not reliably be exchanged for most goods and services, or property and services. So, all right. So that's what's happened. The Federal Reserve note replaced gold as the thing that reliably could be exchanged for goods and services. Gold ceased to be money. Federal Reserve notes continued to be money, just like in the old banking or the old goldsmith situation. Those IOU notes issued by goldsmiths became money and were reliably exchanged for property and services, even if all the gold sat in the vault most of the time. So it's exactly the same situation, all right? So Federal Reserve notes now are not backed by gold. They're backed by force, in fact, the law of legal tender, and I've done a video on that in the Understanding Money and Banking series. You can look it up. I think it's number 4 or number 5. But the point is that when Ayn Rand was writing about the Federal Reserve and about money, she was writing about this phenomenon whereby the government had made possession of gold illegal, had issued Federal Reserve notes in an increasing quantity relative to the amount of gold that they were there to redeem, had made them redeemable for a less and less and less amount of gold, a smaller and smaller and smaller amount of gold over time, as the amount of dollars, the number of Federal Reserve notes, or sorry, not notes, but Federal Reserve dollars comprising the entire supply of Federal Reserve dollars increased over time. She was complaining that the value of each dollar was decreasing as a result of that inflation of the supply of Federal Reserve notes. And you'll recall that in the money speech given by Francisco in the book Atlas Shrugged, he makes a comment that those notes in your hands, which should have been gold, he makes that comment because she's saying gold was preferable to paper, and it was preferable to paper because gold could not easily be expanded in supply, unlike dollars printed on pieces of paper, which can be expanded quite easily, quite readily. She's complaining about the fact that the government has made it easy to devalue the dollar. The government has made it easy to transfer wealth from your savings and earnings to the government, or to whoever is increasing the supply of dollars. It's not that the government was the beneficiary that she's complaining about. It's that the saver and the earner was the victim. I mean, there's nothing per se that she said about, well, I prefer when the thief is a private citizen rather than when the thief is the government. That was not her point. What she's complaining about is theft. The theft of value that results from an inflation of the money supply. She preferred gold because gold is relatively difficult to expand the supply. It's difficult to expand the supply of gold. You have to find it, you have to mine it, and I've talked about that already. Gold is a very useful substance because it's widely wanted. It doesn't degrade. It can be cut into smaller and smaller pieces, etc. But mainly, what makes it valuable is that it's rare and difficult to make not rare. You can't just say, oh, let's pump out some more gold, and there it is. Unlike Federal Reserve note dollars, which you could do easily. You'd say, oh, hey, instead of putting a 20 on there, put a 200. Now we got $200 bills coming off. It makes no difference. It's as simple as typing to inflate the supply of money now, because paper is just a numeral system. It doesn't represent, it doesn't take any effort to expand its supply. Now, it's not that effort makes money valuable. Ayn Rand was not saying, well, gold is valuable because people actually had to expend effort to get it out of the ground. But had they not had to take it out of the ground, had they not had to expend effort, then gold would not be money. That is a non-essential. She's not saying that something is money because someone had to earn it into existence, and therefore gold is moral and paper is not. That's not the point. The point is that she's saying gold is money and should be money because it cannot be expanded in supply very quickly. It's difficult to devalue it by just creating a whole whack of it more. In other words, if you've got savings in the form of gold, if you've got earnings that are coming in the form of gold, somebody can't devalue that earning or that saving by just inflating the supply of gold. You can't do it. It's way too difficult to do. But it wasn't the case that she's saying, well, because it's difficult, it's moral. No, she's saying because it can't be expanded quickly, it, as a practical matter, prevents any immoral act from occurring. That is, the theft of buying power that occurs when the money supply is increased. Now, as I say, she's upset that the Federal Reserve has decided to increase the supply of dollars that are backed by gold. And she's writing at a time when Federal Reserve dollars are, in fact, backed by gold. They were backed by gold, albeit through the Bretton Woods system, albeit an American couldn't get gold in exchange for the Federal Reserve notes, but they still were backed by gold. And they were backed by gold until Nixon closed the gold window in the 70s. So despite the fact that the Federal Reserve notes were backed by gold, she was still not happy. And she was not happy because of the fact that the ratio between the number of Federal Reserve dollars and the actual gold there to be redeemed was continually extended. There was an expansion of the supply of American Federal Reserve dollars, and that meant that people were being ripped off. Their dollars, their savings, their earnings were being devalued. A dollar earned today would buy less 10 years from today, or even 6 months from today, because the Federal Reserve was increasing the supply of dollars. Now, it wasn't just the Federal Reserve. In the United States, anyway, there's a reserve requirement that says a private bank, which, by the way, is lending out dollars, Federal Reserve notes, that's what they're lending out, but they don't lend out the actual notes, they lend out an IOU of those notes, just like the old goldsmiths loaned out an IOU of gold. So Federal Reserve notes for Americans at the time of Ayn Rand's writing had taken the place of gold in the vaults, and the banks, the private banks, had been happy with a central bank that would hold a reserve of Federal Reserve notes, and they were happy with the idea that they could issue IOUs, in other words, bank credit, in excess of the Federal Reserve notes that they actually had on deposit, greatly in excess. In fact, collectively, they had issued about 9 times as much credit as they had actual Federal Reserve notes in existence. And those dollars of credit that they were issuing were money. They could reliably be exchanged for other property or for services. Credit is property. It's a claim. that is in law property, like all other property claims. They are claims. And by expanding the supply of credit, they were doing nothing different than the Federal Reserve, their central bank, in expanding the ratio of Federal Reserve notes to gold. The fact that it's a two-part process does not mean that, well, it's evil when the Federal Reserve does it, but it's hunky-dory when the private bank does it. That's absolutely ridiculous. Because Ayn Rand is not talking about, banks being able to, honor their debts when they're demanded. She's saying that they should be lending out only that which they actually have earned or have borrowed from others. They should not be just inflating the money supply, creating credit out of thin air, and lending it out on the understanding that, well, it's okay because people aren't going to come in simultaneously and ask for all of these bits of credit to be honored simultaneously, so I don't need as much, Federal Reserve dollars as I have issued in the form of claims. I can get away with it. That's the very scam that she was complaining about when the Federal Reserve did it, when the central banks did it, because the process of issuing those Federal Reserve notes constituted a theft of value from savers and earners. It was a seizure of capital. The fact that the Federal Reserve then lends that money out to banks in a productive way does not mean that the money taken by the Federal Reserve, the value taken by the Federal Reserve, wasn't taken. It was taken. Had the Federal Reserve never issued those Federal Reserve notes, or at least had the Federal Reserve never increased the ratio between the number of dollars of Federal Reserve dollars, the number of Federal Reserve dollars and the amount of gold in the vaults, had there always been, say, a 1-to-1 ratio, Ayn Rand would not have complained. They would be mere claim checks. She wasn't complaining about claim checks. She was complaining about the fact that that ratio was changing and that, as a result, people's savings and earnings were being ripped off. The value of those savings and earnings, the value of that property was being ripped off by the act of inflation. It's no different than theft to Rand, and as far as I'm concerned, to me or to anybody else. In reality, it is a theft of buying power. It didn't matter whether the Federal Reserve was doing it or the private banks. And so to conclude that, Ayn Rand thought the Federal Reserve should go, and if so, then private free banking, where everybody just issues credit, enough credit to make themselves wealthy, but only lend it to productive enterprises, and but it doesn't matter that you don't actually have the underlying capital that you're lending out in the form of credit. It only matters that nobody come in and claim all that capital all at once, and as long as you can juggle the balls well enough, then everything's hunky-dory. That's not the case. That's not what Ayn Rand said. She is saying that the very act of representing or inflating the money supply, of creating dollars that you didn't earn and lending them out, of creating IOUs, whether it's Federal Reserve doing it or whether it's a private bank doing it, inflating the money supply devalues the dollar, devalues one's savings that were earned prior to the devaluation, and thereby constitutes a transfer of wealth without consent from those who earned it to those who did not. And the fact that those who seized that value by printing up new credit put it to productive uses, and therefore there was more capital in society and the society was wealthy overall, and etc., is irrelevant. Because the person who was robbed to make that loan possible could have loaned his own money to that same productive enterprise himself and have made interest on that loan himself if that's how he chose to deal with his wealth, what he had earned. If a thief, if a person mugs you and takes money out of your pocket, but then loans it to a productive enterprise and makes interest on it, and as a result society becomes wealthier, we don't say, oh, well then the mugging's okay. You can't overlook that a theft has occurred in the first instance. You can't say, well, because a productive use was made of the money that was stolen, out of the value that was stolen, it's hunky-dory. BS. That's not the case. That's not what Ayn Rand was saying, and I think it's absolutely wrong to suggest that Ayn Rand was therefore in favor of fractional reserves, this idea that as long as you've got, a tenth of the money that you've loaned out in the form of credit, then you're okay, you're morally okay. That's nonsense. Absolute nonsense. In short, Ayn Rand's philosophy, although she didn't actually come out and talk about fractional reserve versus 100% reserve banking, it's not a detail she got into. Clearly, the philosophy is one that says, don't inflate the money supply because it constitutes a transfer of wealth. A transfer that nobody can see. That's particularly evil because no one even can see it occurring. No one's in control of it. No one can stop it except perhaps the government, which can make it illegal, but which hasn't made it illegal and is in fact participating in the process by having a Federal Reserve Bank that's issuing more Federal Reserve notes and more Federal Reserve notes at the time of her writing as claims on the same amount of gold. In my view, Ayn Rand's philosophy is consistent with the idea that a bank should borrow from a person the money it wants to lend out and should never simultaneously owe it both to the person who deposited it and to the person to whom it lends it. A person who deposits, say, a gold coin with the intention that it be loaned out for interest, if there's not to be inflation, must do that on the understanding that while that money is being loaned out by the bank to a worthy borrower, the depositor will not be able to demand repayment of the gold coin. You can't have your cake and eat it too. If you're depositing it with the understanding that a bank is going to act as your middleman and lend it out to a productive enterprise that'll create enough wealth to repay the loan and to pay interest on the loan, such that the depositor will receive some of the interest and such that the middleman banker will receive some of the interest, then the proper thing is for the depositor not to have any right to withdraw the money he has put on deposit for that lending, for the purpose of that lending, until that money has been repaid. And that can be done by specifying in advance a term over which the money will be considered not redeemable, not withdrawable by the depositor. We have these in place already. They're called term deposits, or GICs, guaranteed investment certificates. And that is the way that banking in a moral system, a non-inflationary system, would operate to extend credit to worthy borrowers for productive purposes, thereby increasing the wealth of society without stealing earned value from those who make it, from the productive. Fractional reserve banking, as I see it, is not consistent with Ayn Rand's philosophy. She didn't ever say it was. She complained about fractional reserve banking precisely because it was inflationary, in the exact same sense that the issuance of credit that is not 100% backed by capital, meaning dollars, in this case Federal Reserve notes, is inflationary. And the same arguments apply to private banks that extend credit on a fractional reserve as apply to the central banks, which were set up by those private banks initially, and which inflated the supply of claim checks or Federal Reserve notes relative to the supply of gold. It was wrong for the Federal Reserve Bank to do it, and it's equally wrong for the same reasons for private banks to do it. The same ethical analysis applies, and the reason why it's unethical is that people who earn and put their savings into banks expect not to have that value taken from them without their consent. And I'm talking the value of that earned money taken from them without their consent, because that would be theft. And when you extend credit in excess of the actual reserves you have, you devalue those savings. You devalue that money. You transfer value from that money into this new credit that's issued by the bank, and that transfer of wealth without consent is a theft, not a fraud. It's a theft, and that's why it's immoral, and that's why Ayn Rand was complaining about it. That's why she supported gold as a money supply, because it could not be easily expanded, and therefore people could not easily have their earned value taken away from them. 100% reserve, the objectivist way. Take care.